subject of the alternative options available, and many times, as I did mention, this is normally viewed as a very elite discussion for particular institutional investors. How can retail investors, ordinary investors like myself, for example, get a piece of this pie, if I could call it, if I could start with you, Nahashan?
Thank you, Julians. So we have noticed that Kenyans have actually a very unique taste in investments, and in fact, I think alternative investments are actually the right way to go for retail investors in Kenya. It's what they like to prefer. If you look at in 2016, the National Treasury, through the CMA, conducted a survey and discovered there were 50,000 online forex traders in Kenya. So that's 50,000 individuals, downloading trading platforms and actually starting to trade, currencies and so on the global on the global markets. And that's not an easy thing to trade. And this tells you that Kenyans are really hungry for alternative investments. And this is what actually led the CMA to create the online forex trading regulations in 2017. Okay, and these regulations were actually now meant to create online forex trading as an alternative asset class. Okay, and we as Standard Investment Bank actually were the first ones licensed as a money manager. Okay, so we are licensed as a money manager, which is dubbed Mansa X. And Mansa X actually takes alternative investments, particularly trading in global markets. So we give exposure to our clients in currencies, precious metals, commodities, global indices, and global single stocks. And we do not, the investors we are looking at is everybody. And this is, to answer your question, we're actually taking funds as low as 20,000 shillings. So you can actually, with 20,000 shillings, get exposure in the S&P 500, for example. With 20,000 shillings, you can get exposure to the price movement of gold or silver. So we are essentially taking alternative investments to the retail investors. The uptake has been overwhelming for us, which tells you that retail investors were very hungry for alternative assets. So we run our fund as a multi-asset strategy fund, so typically just investing across the board. And just to brag a little, the NSE derivatives market, we were the first ones to place a trade on that market, okay? Because that's also a market that we are also allowing our investors to get exposure to. Okay. So when it comes to the case for alternative assets and how retail investors can invest, I believe if you have fund managers creating funds that can be able to create economies of scale due to having a lot of smaller investors coming in, and then give the same investors exposure to these alternative assets, then that's the way we'll move forward.
But the question then becomes, especially when you get exposure to this global kind of options.
Yes.
The risk element, because you saw, for example, when you talk about commodities, you saw what happened with the price of oil just about 2 weeks ago when there was a drone attack on the Saudi Aramco.
Yes.
How did you safeguard investors' funds in this kind of incidences?
I'd say if you're running a fund such as ours, whose risk is not only exacerbated by what you mentioned, volatile asset classes, but even more by the fact that we are allowed to actually use leverage by the CMA. So we are allowed the tool of leverage. So essentially we run the fund. It's actually a hedge fund, essentially, but open to the public. The biggest conversation in the fund is risk management. Okay, I like to think of myself as a risk manager. That's my day job. Okay, and my team of trades, my investment committee, the whole affair is run as a risk management, with a risk management bias. So that's the biggest thing. However, it's something that we have to do, okay? Because without taking these particular risks, then we will not cross that particular line into return, okay? Pius just alluded to the issue of how safe is your money, what return am I getting, and what kind of liquidity does this investment option give me? Yeah. So, for example, we then work as hard as possible to create a very conservative trading model within the tools that we have, while still giving clients liquidity, so you can access your money anytime that you like, but also push towards a higher than average return. Okay, so balancing the three dynamics is not easy, but it's something that has got to be done.
I see.
It's something that has got to be done.
Pius, on this subject of how do we get retail investors, but are not retailers, involved in this space of alternative asset classes?
Yeah.
Please.
Thanks a lot. First of all, allow me to just underline the status we're in. Today, I understand we have approximately about 200 retail accounts in our capital markets.
Of which many are dormant, CMA told us.
Of which many are dormant. And this is out of a population of 50 million.
Yeah.
We are talking of financial penetration or inclusion. Today is somewhere in the range of 74%. And the question that has been bugging me is,
excuse me,
if people are very serious about creating their wealth, shouldn't we have at least a similar penetration in the investment space?
Yeah.
And therefore, for me, I think the model of fund management is being challenged here, and change is a must if we have to include everybody in this space we call investment, which is really critical for us, for this country to move forward. Just to come to your question, then we have to ask ourselves another question. Why is alternative asset or investment considered to be highly institutional?
Yeah.
And there are a couple of factors. And the first one is, first and foremost, good deals are very few and far between. Before you find your next deal, I think we have a narrative internally that you've got to look at 100 deals before you get that one good deal. Now, there are not many retail investors who are capable of doing that. I doubt there is any. Two, alternative investments are generally large ticket transactions. We're talking of a couple of millions of dollars. And again, that tends to eliminate a lot of retail investors from that space. Number three is information asymmetry. You have the seller of the business or the seller of the opportunity has so much information compared to the buyer, and therefore you've got to involve a lot of experts and consultants in the due diligence for you to be as close as possible to what the buyer knows, and still you will not be able to have the same information as the seller. Number four is illiquidity. On average, it takes about 239 days to sell a property. That means you've got to have an appetite to be locked in for some time. So, and the fifth one is just operational involvement. You just don't buy a business like Java and you make money while sleeping. You've got to have a very clear value creation plan of how you move value from where you bought it at to 2-3 times what you bought it. Yeah. So the key question then for the fund management community and other investment professionals like ourselves is, how can we then make this a retail accessible to retail? And that's where innovation comes in. There is need for us to have products that make alternatives accessible to the common mwananchi. And one interesting product that we've attempted is the REIT, the Real Estate Investment Trust. That idea originated from America, and the idea was to help the common man to be able to own a piece of prime properties in the city. And I think we should not give up on the idea of REIT, even though it's been a very challenging beginning. I think we need to push this until we get to a place where it is successful. It is potentially a 400 billion plus market that we are looking at, and therefore it is worth fighting for.
I see.
The private equity, I think we need to have products that can act as feeders to bigger private equity funds, because the minimum tickets are quite sizable. True. And I think that's how we'll be able to help retail investors to participate in alternatives, which tends to have a relatively higher return compared to the traditional markets.
And Pius, you did mention this is a challenge to our model of fund management, and I want to hold you onto that thought, because many times when you speak to institutional investors, they'll tell you there's a reason for that, because many of these alternative asset classes are, if I could say, relative to traditional classes, less regulated. You just mentioned Forex. Regulations had to come much later on. So they always feel it's still in the guinea pig phase, if I say, and we're still trying to test the waters to see how this will pan out. Don't you think that's a viable argument from their side?
No, I think I'm in the space, and one of the things that we often find ourselves is seated in front of the Capital Markets Authority, and trying to push boundaries. And what we found out is actually they are very accommodative, and they are very much willing to listen to new ideas that can help in deepening the capital markets. And I think as investment professionals, we should. This is our time to change the narrative so that we have as many people owning investment accounts as they own bank accounts. And I think that, for me, is my personal challenge. That's the impact I would want to see as my legacy.
That's it. And Angela, on the subject of innovation that enables us to cascade this discussion from the institutional investors to retail investors, he's given the example of the rates, which you had actually mentioned earlier. Do you feel enough is being done to bring in products which now begin to, rope in retail investors into this space?
That's a very good question. I don't think there can ever be enough innovation. And I think that a market to survive, a business to excel, must continue to innovate on a continuous basis. But if I can just focus a little bit on the retail conversation, I think you had asked about the alternative asset classes and how retail investors can participate. But I'd like to take us a step back and ask, what is the level of participation of retail investors in the capital markets to begin with? Earlier I had said that currently when you look at the 1.16 billion sitting in pension fund assets, that's about 18% of the GDP. That only comprises savings of 22% of Kenyans saving informal employment. And when you look at the 80% of Kenyans in informal employment, there isn't much, less than 1% of that is attributed to them. So in terms of mobilizing capital, I think the first conversation is to ask, how can we increase penetration? Without necessarily going into the detail of whether it's capital or alternative, is first, how can we mobilize these savings? And I think when we were talking about innovation, one of the things we've done is launching very shortly a product called Fahari, which is digital pensions. And just off your phone, an individual is able to self-service, enroll. It's very easy, very simple, and any person who has a mobile phone is able to do it. We've also learned through our studies that are being done that in the informal sector, you might not have a lot of individuals who have a smartphone. And this means that either you're having, the groups of women doing table banking where they share one mobile phone for every 20 women. And so the way you set up your digital account has to allow multiple users over one platform, or alternatively using the USSD model. So in terms of innovation, when you look at products like Fahari, which are trying to mobilize savings from the informal sector, that brings more money into the space of investments. And I think once you have more capital on the table and you have additional flows into the capital markets, getting into the alternative space becomes a little bit easier. Because I'm a bit of an alternative thinker, I'd like to say that Kenyans love real estate. And I'm not sure how the panel sits, but being a Kenyan, it's almost as though if you don't own land, you're not a son of the soil, So I think real estate might not necessarily be one of the alternative asset classes where retail investors have an immediate challenge. Because I think it's either through individual investment or perhaps through inheritance that you might have access to that asset class. But I think the bigger question is for things like private equity, things like, you talked about the derivatives market, ETFs, you have gold, I think even art, that's where, unless you have a very, can we call them like high net worth individual investor, that the general market might have trouble accessing those investments. So players in the market are doing a lot of work to innovate. And as I said, Kenyans being as they are, it's only a matter of time until you see a private equity fund of funds that's targeting the retail market. So we are moving in that direction. I think the challenge with the real estate investment trust was, not necessarily a timing issue, but that appreciation of how are you translating this solid asset class into chunks and people are buying it, the pricing, the classification on the investment guidelines with RBA. So it's definitely a right move. And perhaps one day a time will come when Kenyans are not very emotional about real estate, and they will see it just as an investment, the same way you have stocks and bonds, and they're willing to trade, because generally, unless there's something going on, you would hardly find someone willing to part with. So we have a little bit of a unique endowment bias on real estate that is unique, different from what you see with other asset classes.
Yes, and the Fahari product you mentioned just sounds pretty much like the Emma Kiba model, you know, where we crowdfund essentially from a government standpoint. I want to bring in Caleb on this side, and critically because he's on the real estate side, and of course a lot is being mentioned. When you look at the degree to which at least it's being opened up to retail investors, of course we've had the conversation around rates. What do you think is the future of this kind of participation?
Well, as we said, thank you. There are a number of issues in accessing alternative investment. These investments you say liquid, mainly long-term, a bit high risk, and thus not as accessible for retail investors. However, now as an industry, what we have to come in and do is to try and structure products around these alternative investments as underlying, like what we do at Cyton. We take in funds from retailers, from investors, high net worth institutions, all that. And we invest in real estate as an underlying asset, but still having structured the product around some public investments and also some alternative investment, so that we can address some of these issues of illiquidity, of long-term investment and the like, because that's the only way that you're going to be able to appeal to retail investors and the market in general. Another way you can actually look at it is where retail investors actually more comfortable in putting their funds. We see that the unit trust funds model has really been taken up. I think it's also one of the fastest growing products in our market. They're growing faster than deposits, bank deposits, faster than possibly participation in the equity market, especially by retail traders. So if by nature of retail investors, they're more inclined towards some of these unit trust products like the money market, balance funds and the like. Is there a way that we can access alternative investments from these products, the collective investment schemes like the money market and the like? One thing you can also look at is within the setup and structure of these unit trust funds, is there an allocation to alternative investments that fund managers can set up, so that also the retail investors can be able to access these investments and returns?
Okay, and staying with that subject of real estate, because lately there's been a lot of, should I say, concern or discussion around what's developing in that space. And anytime you open the newspaper on Monday, it looks like an auctions bull market, you know? Yeah, because essentially it's property after property after property. And the whole idea is that many Kenyans, as Angela rightly pointed out, for a long time, that was the ultimate alternative for many of them. But now you find yourself in a place where the market is essentially cooling off, at least a segment of it. And if you were taking, for example, a mortgage and you're servicing at 18%, and what we call the rental yield, whereby the amount you're getting from your rent to service that mortgage is about 8%, many have been left with their backs against the wall. I just want, first of all, to get your thoughts around what's really happening in this space as an alternative asset class. Pius, you look like you're ready for it.
You know, I have a friend of mine who likes saying that that the earth is the best investment on earth. Meaning real estate is the best investment on earth. And I think it's because of one distinct trait that real estate has, that it is not a movable asset.
Yeah.
And therefore, the idea that you lose your money then doesn't really apply. But it's still an asset. When you think about it critically as an investment professional, it's still an asset. And what we've experienced over the last 10 years, there was a lot of speculation on land. And because it's a very unstructured sector, people are simply buying a piece of land today and offering it in the market the following day for 2 times what they bought. And because there is no reference point for pricing, the next guy would buy, and that story would get to people in the diaspora, and the people in the diaspora would come and fuel it even more.
Yes.
And therefore, we've reached at a point where the cost of land is so high, it makes up 25-30% plus of the total project cost.
Yeah.
And now, if you start from such a base, it's very, very difficult for you to develop an asset on it that can give you rental yields that can compete at least with government securities, which is another challenge that we have. That the government has such appetite for borrowing, and it's borrowing at your 12%, and it's difficult to match that from a rental yield perspective. So then we are in a situation today, the only people who are sitting pretty are people who bought their assets a while ago and cheaply,
Yes.
and I mean land. And therefore, they can be able to develop their assets and be able to pass those economics to the eventual buyer. And I think that's what is happening at Centum Real Estate, the Vipingo. The cost base of the asset is not so expensive, and therefore they're able to offer those economic benefits to their ultimate customer. But today, if you're buying a piece of land today, it's almost impossible that you make money. Your payback period will take much longer time than compared to before. So it's an interesting time that I think either the economy will grows faster and be able to the disposable incomes increase enough to boost the rental yields so that they make sense, or there's a reduction in prices, which,
as we have seen in
which
some.
again, but is it sufficient? The question is whether it's sufficient, because still the rental yields don't
make sense.
Don't make sense. And I think the underlying issue is the fact that most of the properties were bought not too much with borrowing compared to other markets, and therefore, what would burst a bubble we don't have that trigger.
Yes.
So I tend to joke it's like someone with a bloated stomach but is unable to release the wind.
I see how cautious you are around when you said that we're not bought with the mortgage. I think we all get what that means. But moving on to Caleb, because this is really sitting under your docket in terms of what's happening in the landscape. Really trying to make sense of the developments in the real estate market and whether it actually still makes sense for many as an asset class.
Yes, thank you. One of the main issues, again, as Pius has mentioned too, is the high cost of land, and that's actually one of the major drivers for things like affordable housing not being that, the take-up being that good, because in order for you to actually construct an affordable house on a piece of land, the land cost has to come quite lower, because 30, even sometimes 40-50% of your development cost is land cost. But also how I try to look at it is you have to look at do a lot of research before you come into any concept or design stage that on the real estate development that you want to undertake. There's some sectors, themes that are not doing that well. We have oversupply in segments like the office space, retail, and so yields are coming down. And typically, for a lot of investors in this market, once they see the price coming down, they don't want to sell, so they keep on holding on to the asset. So it becomes an unused space. But in terms of how you approach the market has to be really research driven, looking at the small pockets of value, especially in and around Nairobi. You have some concepts that are still doing okay, residential for instance. Mixed-use developments also are quite still picking up. So then the issue then becomes how you're able to transfer these returns to your clients and investors. And now that's one of the things that we're looking at in terms of structuring products that are geared towards investing in these concepts. while still maintaining your ample liquidity and duration risk and addressing all these other factors. So it's a market. There is a time that there's a boom and bust, but as we've actually addressed this issue quite a number of times of there being a bubble or not in our economy. The thing about bubbles again is access to credit, which is not that cheap, and we don't have a lot of mortgage uptake. But some of the issues or some of the I'll say initiatives that are going into that, we have the introduction of the KMRC, the mortgage refinance company, and also reduction in I'll say expense of loans, trying to reduce the interest rates, possibly also lengthening the tenure of mortgages, just to try and spur uptake by residents and investors to own a home, because the percentage of homeowners even in and around Nairobi is close to 20-25%, and this is quite low.
Okay, Angela, any additional thoughts on the subject of real estate?
Well, I think real estate, in this market continues to be a viable investment. I think that with any investment, you will go through a journey where you have the capital chasing. You will have, similar to all other assets, an element where you have a rebalancing between supply and demand. And I think that the question always is, what is a fair value, as Pius said. And right now, I think we all appreciate that as Kenyans, we've been a little bit spoiled on returns. And we generally have investors who are used to double-digit returns year on year. Yeah. They're used to 17s, 18s, 20s. And so whether it is in real estate or it is in equities, when they're facing a return of 8, it almost seems as though that is a muted return. But if you compare those returns with other markets, you'll see that real estate markets, offshore, are giving you 2 to 3%. And as such, the 6 or 7 or 8% is a competitive return. So I think what we need to do as investment professionals is put these asset classes into context, because when they've had a run and a great run, then there is a change of expectation in the market. And when the market comes back into reality, you have almost like a disappointed investor, when what really has happened is what you typically expect with any other investment. So I don't think real estate is too different. It is an asset class. It will go through the journey of any other asset class. But when you compare it with or benchmark the returns in this market with other markets, it is still quite competitive. So there is room for growth in the real estate market. I see.
And the consensus view seems to be that there's what is happening is essentially a correction, not
Yes.
that it's anything debilitating. Nahashan, you seem to have a point there.
Yeah, when it comes to the returns on real estate, I think there are two things here. The underlying price of land has traditionally been so overvalued that the rental yields, I think in Nairobi, are at around 4 to 5%. Mm-hmm. So that's
some as low as 3.
Some as low as 3%. So when we talk about the fact that real estate is giving a return that in other markets is considered a good return, but from a Kenyan context, a 3% return with inflation hovering above, okay, right now we are at 5, but traditionally around 8%, that's not acceptable. And that's a sign of an underlying problem. Mm-hmm. So any asset class has to be subjected to the same test. The price of any asset class should be a factor of the future cash flows of that asset class. Yeah. So traditionally, real estate, for some reason, has escaped that valuation. Okay, so everybody has valued land based on, I can sell it to the next person at a higher price. So essentially, we turned buying and selling of land into a giant pyramid scheme. Mm-hmm. And it's now showing. How does it show? Because if we build an apartment block, based on the price that I bought this land, I cannot even pay a loan. Okay, we can argue that a lot of investments were done via cash, so nobody cares. But in reality, I'll still look at opportunity cost if I'm an investor. I'll still think, okay, I can still get 8% from fixed income, for example. Mm-hmm. So why should I be accepting 5% in this asset class simply because I bought it in cash? You're still missing the opportunity cost. So there has been extreme mispricing in the real estate sector. So I'm actually of the opposite opinion. I think it's undergoing a correction, but this correction might be sustained. It might be sustained. Why? Because you had a period where there was really a lot of hot money going into real estate that caused extreme overvaluation of real estate assets. So this has to be then diffused over a period of time, which actually builds the case for more investments into now alternative, other liquid investments. Okay, because I think the other factor that's even more scary about real estate is not only are the returns low, they are also very illiquid. So you have you have a confluence of two negative factors. So I think the correction might be more sustained.
Piers, please.
Yeah, I just have one thought to add to that. I think, just to put into context, futuristically, the demographics are such in favor of real estate. We're saying 50% of the population is 15 years and below. 50% of the population, every day we wake up, they go to school or they remain at home. All these guys will need somewhere to rent or something to own, a house to own in the future. So the key thing that we don't know how it will be resolved is just the question of pricing.
Yeah.
Once the question of land pricing is resolved, the opportunity is immense, and anybody who is holding large chunks of land at a good valuation is really sitting on a prime opportunity, because of the demographics. Majority of the Kenyans don't own homes, and therefore, if you play into that, because you are answering to a very specific pain point, then I think there's lots of money to be made in real estate.
And Angela?
In the future.
So just one thing to add for those investors who are currently holding real estate, I think there's also room for innovation in terms of what value you can add in order to boost your rental yield. I think we've seen different initiatives in the market. We've seen mixed-use developments that will combine, a shopping mall, plus everything that you need there. We've seen individuals introducing things like Wi-Fi, transport, So I think there is room. If you're currently holding real estate, there are opportunities for you to add value. Currently, the Kenyan investor is doing a flight to quality. So if you're holding the same asset as somebody next door, but you've not added value, for instance, if you're holding real estate in an area where water is a problem, and you've not sorted that out, then you definitely cannot boost your rental yield. So I think real estate owners have an opportunity at the moment to go back and ask themselves, what are the easy or quick things that I can do to add value to the person who I want to come into this building to ensure that they're sorted. Some even have home cleaning services as part of the rental yield. So I think there's space for innovation in the current situation to improve the yields that investors currently have if they're holding real estate.
I see. And as we begin to wind up our conversation, I want to bring in a question where essentially I merged the traditional investments with the alternative. And I remember engaging in financial advisory, and many times would get into a negotiation for a particular deal. And the question from what we call the buy side, the guys who are putting in money, always came in that what finally is the viable exit once we've realized our return. And it was a recurrent challenge, even in terms of people just tapping into various opportunities that exist in the market. And oftentimes the challenge we would be posed is we don't have, the stock market doesn't give an extremely viable kind of exit. I don't know from where you sit, especially who's on your side, what do you normally see? Is this a key challenge as I perceived it or not?
I think the investment cannot be said to be successful or otherwise unless there's an exit.
Yeah.
Because it's the exit that you get to realize the cash flows that you initially anticipated. Now, there are multiple channels to exit, and one of them is, of course, through the stock market, the capital markets. And the statistics for the last couple of years haven't been very encouraging.
True.
And I think over the last 15 years or so, the number of listed securities have remained relatively the same. Meaning, I think there are deeper questions that the Nairobi Securities Exchange and the Capital Markets Authority need to be asking themselves, how else can we incentivize these big ticket exits to come through the market, other than privatization. So the most natural route for exit today is a straight sale to another PE investor or another strategic investor, and I think it's also part of the challenge that is coming through the wall of money that has been looking for home in this market. And when I speak in this market, for example, I'm just speaking relatively. Today, if there's a fund, a PE fund that has been set up in the US, and it is dedicated to invest in Africa, where would they start investing? Nigeria is not as attractive as it used to because of the commodity volatility. South Africa has its own challenges. Egypt is just recovering from the Arab Spring, and maybe that would be competing with East Africa. But when it's either North Africa or East Africa, where you have diversified economies. And when you talk about East Africa, then you speak about Kenya. In fact, I was just looking at the numbers. There are 61 private equity deals that have happened year to date. 57 of them have happened here in Kenya. And altogether it's about $1 billion. So you can see there is action happening because of this wall of money that is looking for opportunities here. And it hasn't been easy for private equity funds that have raised money elsewhere and have tried to deploy here. And therefore, any opportunity that is of good scale and of relatively good quality will have many takers in the market. That's our experience. Even when you're negotiating with one, you'll find another one saying, how can I up my price and give you a better deal?
I see.
And I think it just speaks to the wall of money that is out there looking for opportunity, and maybe that is playing to the disadvantage of the capital markets.
Now, Hashan, some views on this, the exits?
Well, definitely you have a lot of money trying to look for opportunities. Right now, Kenya is the only viable option. Right now in Africa, if you were putting your money, you'd definitely be putting your money in Kenya. But we definitely have to find a way of mobilizing local capital so that there is enough local capital participating in our capital markets, enough to offer foreign investors an exit. Because you can't have private equities exiting through other private equities simply because you don't have enough local participants, which brings us back to the original conversation. Why do pension funds only have about 3% of their funds deployed in private equity? And what opportunities are they missing that all these foreign investors are fighting for? If you're talking about $1 billion fighting for opportunities in 57 PE deals, that's very significant. It tells you that from where they sit, they're seeing so much opportunity here that they're willing to risk investing without an exit. Whereas our own pool of capital and the best placed pool of capital is obviously our pension industry and our fund management industry, are struggling to justify to themselves why they should invest in this. So the only way to create proper exits is to develop our own capital markets. And that's something we as investment professionals locally have to do. It's our prerogative to do it.
I see. Angela, you seem to share that view.
Well, I have two comments, I guess, on that matter. And I think just going back into the pension fund industry, the one thing to note is that while before you would have employees with a 30, 40 working cycle, the working cycle right now is 4 to 5 years. And as such, you will find that when you're looking at a conversation on exit, for a board of trustees, it's very important, because the question is, if I'm holding funds for individuals who will be exiting every 5 to 6 years, I need to be sure that I can relatively be able to access it in the event that I need it. So exit is actually now over the hurdle rate of return, and of course the legal provisions within a PE fund. One of the key things that a board of trustees or a pension fund manager would be looking at. So if you can't really speak to a successful exit strategy, then you might find that there might be concerns, primarily driven by the nature of pension funds having to pay out. And remember that there is a legal provision to pay out benefits within 30 days, which is not negotiable with members. But just to go back into, I think, two initiatives I've seen that I think are trying to deal with this issue of exit, but in a little bit of a different way. In the private equity space, we've had funds of funds being set up. And funds of funds work in a good way because an investor is investing not in one private equity fund, but in one fund that's investing in other funds. And as such, the risk of exit is much, much smaller if you're in a fund of funds as opposed to in one private equity fund. We've recently launched one called the Ngao platform, and I think it's not the first, I think it's the second. We had one initiative by Sanlam a few years ago, and I think this is really the direction that you're going to start to see the market moving into as one of the ways of dealing with the exit question, or this whole concern about due diligence and expertise and the headache. You know, do you do an agricultural fund? Do you do an energy fund? You know, so once you have a fund of funds, then that becomes the work of an expert manager to deal with. The other thing that I can mention, and I think we haven't yet touched on it as an alternative asset class, is infrastructure. Infrastructure for a long time has been one of the conversations that the government has been trying to have with institutional pension funds. And if you look at countries such as the UK, most of the main roads were actually built by pension funds. And we've had initiatives where, such as I said, the Kenya Pension Fund Investment Consortium, where pension funds are coming together to try and negotiate better terms, because, you know, infrastructure is a big ticket, as Pierre said. $2 to $3 million is not an easy feat, and to get through all the rigmarole, negotiating the capital guarantees with government, you know, and ensuring that there's a successful exit for one retirement fund might be a tall task. So when you see pension funds coming together and trying to use the law of numbers to kind of negotiate, I think it also gives them a better chance of designing a vehicle that gives them a better chance of success. And to go back as to why I think the 3% might still be 3%, but as a hope of increasing, is currently private equity funds, as they are structured, still have not addressed all the concerns that a board of trustees might have. Typically, you'd find that in this market, only 20% of retirement funds have assets in excess of 1 billion shillings. And as such, if your ticket size is $1 million, automatically you've locked out 80% of the pension fund market. So unless private equity funds are willing to offer smaller ticket sizes, are willing to perhaps make it easier to go through the legal due diligence process, reduce the cost of it, are willing to offer a hurdle rate of return that is more than 6%, because as you've heard, you know, if a T-bill is offering you 7 or 8, then to compete. So when you look at the conversation that the private equity funds need to have with investment professionals, I think they need to do a little bit more to lure. The capital is there, the interest is there, but I think there's an awareness that this capital is competing with other investment classes.
I see. I wish we had time to delve into the infrastructure subject, because I've got a very strong opinion about it. But because we have only 5 minutes, I want us to get to the winding thoughts. If I could start with you, Caleb, coming this way.
Okay, maybe just a quick note on the exit strategy.
Sure.
I think in terms of the strategies, the ideal way is actually through an IPO. However, in terms of the performance of companies that are listed, is not that attractive. So possibly as investment professionals or funds that are looking to invest in this space, we can look at like go into more in terms of venture capitalist, where then we can exit to a fund of funds or a private equity, a larger private equity firm, just to start with a business from the early stages, and also contribute to its scaling up, because scalability is also one of the biggest factors that drives investments into this space. Otherwise, in terms of alternatives, I still think that it's one of the main ways that you can engineer your portfolio to earn superior risk-adjusted returns, especially in this area of depressed returns in the traditional markets, your equities and your fixed income. As investment professionals handling portfolios, you do have to allocate something to your alternative investments. You have easier accessible alternatives like your real estate. But now you also have to look at the risk that you're going to invest in. Do your due diligence, do your research, make sure that you're investing in something that has better future expected cash flows, and you should be okay.
All right. I'm glad you didn't say alpha when you're talking about superior risk-adjusted returns. Angela, your closing remarks?
Oh, my closing remarks would be that, as Pius earlier said, that with investments there is no return without a risk. And I think as investment professionals, we need to work harder to ensure that we're providing the market with alternatives that are offering them a reward for the risk that they're taking. Zamara did a survey, a performance watch, that actually showed that over the last 10 years, the Sharpe ratio of fixed income was 0.4, while that of equity was 0.1. And that really tells you that there is a question around the risk that we are taking and the reward. So looking into the alternative space, we need to compete, but we need to ensure that the alternatives we are providing truly are offering a reward to the investors for the additional risk that they're taking.
All right. Pius?
Well, I think I would just go back to the statistic that I mentioned. There are only 200,000 accounts, approximately, of individuals investing in our capital markets. And it just speaks to many things, how the business model of fund management needs to change, and how the mentality of retail investors also needs to change. So my parting shot is, investment is not a side hustle. Investment is your core hustle.
Yeah.
We go to work to mobilize capital,
To invest.
to be able to invest. Once we secure investments, we have a secure future. So investment is our core hustle, and everybody needs to understand that. And I would encourage every individual out there to go to visit the various fund managers and open an investment account. And sorry?
Or investment banks also.
Open investment accounts. It is time we push this number to where the bank accounts are, so that we can have a much more muscle to be able to negotiate better opportunities for them with bigger tickets. We can be able to do a lot more for the retail and be able to secure their future better. The infrastructure funds that we're talking about, those are things that can be done. And just to give an example, there are 14 IPPs in our energy sector here. And I think only one is owned locally. The rest of the 13 are owned by foreign investors. And guess who are the ultimate beneficiaries? Individual pensioners seated in Europe and America. So we, as an investment community, we have a huge task ahead of us to be able to penetrate investment to every sector of the economy, and ensure that everybody is given an opportunity to secure their future.
Thank you.
Thank you very much.